If you're collecting Social Security and still working or planning to, misunderstanding one rule could push you into a decision that costs six figures over your retirement, and it's probably not the rule you think. The earnings test, the rule that supposedly punishes you for working while you collect. There's a bill in Congress right now that would erase it entirely. Stranger things have happened. Last year, for example, Congress repealed two rules nobody thought they'd ever touch. So it's not impossible. But here's the part the headlines aren't telling you. Most people get this rule so wrong that even if Congress never lifts a finger, the misunderstanding itself walks them straight into mistakes that cost real money. So today, I want to walk you through what the earnings test actually does, why this bill probably won't pass, and the three Social Security rules that may hurt you a lot more than this one, whether the bill goes through or not. So stay with me, this one matters. If you're somewhere between 55 and 70 and you're still working full-time, consulting, sitting on a board, maybe running a small business on the side, you've probably wondered what happens if you start Social Security before you stop working. And you've probably heard you'll lose it. That if you earn too much, the government takes your check away. That's the story everybody's heard, and it's wrong. But the truth is more complicated than the explainers tell you. So let's actually do this the right way. I'm Mark Fonville, a certified financial planner and the CEO of Covenant Wealth Advisors. We manage nearly $1 billion for retirees in your situation, and we plan retirement, income, taxes, and investments as one piece because that's how they actually work in real life. So here's what we're going to cover in today's video. Okay, pillar one, what the earnings test really does. If you're collecting Social Security before your full retirement age, that's age 67 if you were born in 1967 or later, there's a limit on how much you can earn from a job or self-employment before Social Security starts holding back your check. For 2026, that limit is $24,480 a year. Earn $1 over that, and they withhold $1 from your benefit for every $2 you earned above the line. In the year you actually reach full retirement age, the rules get more generous. The limit jumps to $65,160, and they only withhold $1 for every $3 over that. And then the month you hit FRA, the test disappears entirely. No limit. You can earn whatever you want, no withholding ever again. So far, fine. That's the rule everybody thinks they know. So here's the part few people actually know. When Social Security withholds part of your check because you worked too much, that money is not gone. When you reach full retirement age, they recalculate your benefit as if you had claimed later by however many months they withheld. Your check goes up permanently for the rest of your life. That's straight from Social Security, not me. The withheld money comes back to you through a higher monthly check over the rest of your retirement. The rule isn't a penalty, it's a forced delay with a payback built in. Now, I want to be honest about one thing. The payback is slow. It can take more than a decade of higher checks to fully recover what was withheld. If you don't live that long, you don't fully break even. So this isn't free, but it is not the permanent ripoff most people believe it is. Okay, pillar two, and this is the one that should make a lot of you breathe easier. Only two things actually trigger the earnings test: wages from a job and net self-employment income. That's it. Bonuses, commissions, vacation pay, those usually count because they're wages. Everything else is off the table. Pensions don't count, annuities don't count, interest, dividends, capital gains, none of it counts. IRA distributions don't count. Your 401k withdrawals don't count. Rental income doesn't count. Veterans benefits, military retirement, government pensions, absolutely none of it. So think about what that actually means. If you're already retired and you're living off your portfolio, pulling from your IRA, taking dividends from a brokerage account, collecting a pension, you can collect Social Security and not lose a single dollar to the earnings test. It does not apply to you. This is the part the financial industry doesn't shout about. For a lot of the retirees we work with at Covenant Wealth Advisors, their earnings test is a non-issue. They're funding life from investments, not paychecks. The rule just never touches them. The exceptions are the folks still earning real wages, the consultant who hasn't fully retired, the part-time professor, the board member with director fees, and the small business owner. Those people need to do the math. Everybody else, just move on. Now, quick one while we're here. Are you still working past 62? Drop it below. Full-time consulting, board work, small business, it changes the math and I read every reply. Now, if the rule doesn't even apply to most of you, why is Congress trying to repeal it? And should you plan your retirement assuming it'll be gone? That's next. By the way, if this is the kind of clarity you wish you'd had a decade earlier, hit subscribe. We publish a new retirement planning breakdown every week. Taxes, Roth conversions, Medicare, withdrawal strategies. The next one might be the one that changes your number altogether. Okay, so the bill. It's called the Senior Citizens Freedom to Work Act of 2026. Senator Rick Scott introduced the Senate version in March, and Congressman Greg Murphy introduced the House version in April. Both bills would wipe out the earnings test entirely for everyone at every age below FRA. So that's a real bill, real sponsors. And Congress did surprise everyone last year. They passed the Social Security Fairness Act and repealed two rules nobody thought they'd ever touch. So I can't sit here and tell you that this can't happen. But GovTrack, which tracks bill probabilities, currently puts this one at roughly 0% odds of being signed into law, about 1% of getting out of committee. So why so bleak? Because some version of this bill has been kicking around for decades. Senator Scott introduced it back in 2021, Congressman Murphy in 2023, and here it is again in 2026. And the full repeal has never passed, not once. The 2000 law fixed the part above full retirement age, and Congress stopped there. The part below FRA has been left alone every single time. Now, there's a reason, and it's not laziness. Repealing the earnings test below FRA means Social Security pays out more in the near term at the exact moment the trust fund is heading toward a 2033 shortfall. The math gets harder, not easier, so there's real institutional resistance. So here's my honest take. Could the bill pass? Anything's possible, so should you plan as if it will? Absolutely not. Plan around the rule that exists today. If repeal happens, you get a bonus. If it doesn't, you weren't caught flat-footed. And here's the thing. Even if you ignore the earnings test completely, even if Congress repeals it tomorrow, there are 3 Social Security rules that will hurt you far more than this one ever did. And this is where the real money is. Landmine number 1, the permanent early claiming reduction. If you claim Social Security at age 62, you lock in a reduction of up to 30% for life. And this is a different animal from the earnings test. The earnings test only holds your checks back temporarily, then pays them back. This reduction is permanent. Every month you actually collect early, your benefit is cut, and that cut never comes back. You're stuck with a smaller benefit every month for the rest of your life. And if you just delayed to age 70, you'd add roughly 8% a year on top of your full retirement age benefit, up to 24% more. And that's permanently. And that source is the Social Security Administration. So landmine number 2 is the taxation of your benefits. You can owe federal tax on up to 85% of your Social Security check, depending on something called provisional income. The thresholds, $25,000 and $34,000 for singles, $32,000 and $44,000 for joint, were set in 1984 and 1993. And Congress never indexed them to inflation, which means almost every retiree we work with hits that top tier. And those no tax on Social Security headlines from last year's bill, well, they overstate what actually changed. There's a temporary $6,000 deduction for people 65 and over, but it sunsets after 2028. And the three-tier taxation or structure on Social Security itself is unchanged. Don't plan around a deduction that vanishes in 2 years. And that source, by the way, is the IRS and One Big Beautiful Bill Act in 2025. So landmine number 3 is IRMAA, and we've talked about it before in our other videos, and that's what's called the Medicare cliff. Medicare Part B and D have income-based surcharges that start above $109,000 for singles, $218,000 for joint filers, and it's a cliff, not a ramp. $1 over a bracket triggers the full surcharge for that tier, and it uses your income from 2 years earlier. So a big work year now can hand you a Medicare bill 30 months from now you didn't see coming. Let me walk through a hypothetical. Sarah is 64. She's got a $1.4 million portfolio. She's still consulting at about $80,000 a year. She hears about the repeal bill, figures she'll come out ahead and claim Social Security at 64. The earnings test withholds part of her check. She'll get that back later. Fine. But she just locked in a 20% permanent cut to her benefit. That's exactly what claiming 3 years before FRA actually does. Forever. If she lives into her 90s, that smaller monthly check can add up to 6 figures and lower lifetime benefits. Now, claiming early does hand her a few extra years of checks up front. So how it nets out depends on how long she lives. But for someone healthy at 64, with a long runway ahead, waiting usually wins. Then there's the tax. Her $80,000 wage plus Social Security pushes 85% of her benefit into taxable income. She's paying tax on money she thought was tax-free. And then 2 years later, IRMAA. As a single filer, her wage plus Social Security plus income off that portfolio tips her over the first bracket. Her Medicare premiums jump. The earnings test was the smallest of her problems. Those 3 other rules are where the actual bleeding happens. Okay, quick one before we wrap. What's the one Social Security rule that's confused you the most? Is it the earnings test, IRMAA, taxation, spousal benefits? Go ahead and drop it below in the comments and I'll tackle the most asked question in a future video. All right. 3 takeaways before we wrap it up. 1, the earnings test is real, but withheld benefits come back as a permanently higher check after full retirement age. It's a forced delay, not a permanent penalty. 2, for most retirees living off a portfolio, the earnings test doesn't apply to most of their income anyway. Pensions, IRAs, dividends, capital gains, rental income, none of it triggers the rule. And 3, the bigger threats are the permanent early claim reduction, the taxation of your benefits, and the IRMAA Medicare cliff. Get those 3 right and the earnings test is just a footnote. Here's your next step. If you're trying to figure out when to claim, how the earnings test actually applies to your situation, and where your tax and IRMAA exposure sits, grab the Social Security claiming checklist we use with clients. It walks you through claiming age, the earnings test, spousal and survivor coordination, and how your benefits get taxed. It's free along with the other 15 retirement planning checklists we run with many of our clients here at Covenant. So the first link is in the description down below. And here's the thing about Social Security. Most people are afraid of getting it wrong because they don't understand the rules. And then the fear drives the mistake. Understand the rules, and the rules stop running you. That's the goal. Now that you know what the earnings test actually does and what it doesn't, the next question is when you should actually claim. I walk through the math on claiming at age 70 on the next video, so be sure to watch that next. I'll see you on the next one.